Some people say you can't beat the market with dividend ETFs. Others say SCHD is the only ETF you'll ever need. So, who's right? Now, let's face it, we all want investing to be simple. Buy a great ETF, watch the dividends roll in, and live your life. No complicated stock picking, no market timing, no constant worry. That's why so many investors love SCHD. It's one of the most popular dividend growing ETFs today. But is it really a set it and forget it investment? Or is that just marketing hype? Today, I'll walk you through the real data behind SCHD, its dividend growth, its portfolio, and how it holds up in retirement. And yes, we'll talk about what happens when the markets turn ugly. Spoiler, it doesn't always shine like people claim. In fact, and here's the controversial part, some people think SCHD is starting to lose its edge compared to growth ETFs. But is that true? Stick around and let's dive in. Chapter 1: SCHD's Dividend Growth Engine. What the numbers say. Alright, so what makes SCHD so powerful? It's not just about owning dividend companies, it's about how fast those dividends actually grow. Let's look at the numbers. Over the last 12 months, SCHD grew its dividends by over 12%. Over 5 years, the average annual growth rate was almost 12%, and across 10 years, still around 11% per year. Now, here's what that means. If your dividend grows by 11% a year, your income doubles every 6 to 7 years. That's the rule of 72 in action. And no, this isn't theory. It's happened. Every single year since SCHD launched, its dividend has grown. So think about that. You're not just collecting a 3.5 to 4% yield. You're watching that cash flow snowball, year after year, without needing to chase risky stocks. And here's something a lot of ETFs miss. They either have high yield and low growth, or decent growth, but a tiny starting yield. SCHD is one of the few that balances both. But, and let me be clear, this doesn't mean the stock price skyrockets every year. Total return may trail tech-heavy funds sometimes. But the income story? SCHD plays a long-term game. So far, so good. But where do these great companies come from? That's what we'll look at next. Chapter 2: SCHD's Stock Selection. Why it picks winners and ditches losers. Let's break down how SCHD actually picks its stocks. Because honestly, this part is what separates it from most dividend ETFs. First, SCHD only picks companies that have paid a dividend for at least 10 years straight. Right there, it filters about 90% of the stock market. So no risky startups, no unpredictable small caps. Next, each company has to be big and liquid. We're talking at least $500 million in market cap and $2 million in daily trading volume. That keeps things stable and tradable. Then comes the real magic. The companies are ranked by 4 key factors: free cash flow to debt, return on equity, dividend yield, and 5-year dividend growth. So it's not just yield chasing, it's quality hunting. And here's what's smart. No single company can be more than 5% of the portfolio. No sector can take up more than 25%. That means SCHD stays balanced even when certain stocks rally. Plus, they rebalance quarterly. If a stock runs up and throws off the balance, they trim it back. Lastly, there are no REITs in SCHD. Why? Because REIT dividends are taxed differently. SCHD sticks to 100% qualified dividends. So what you're left with is a high-quality, tax-efficient dividend machine. Let's see how it performs in real life. Chapter 3: SCHD's Practical Results. Real Retirement Scenarios. Now, let's stop talking theory. What happens if you actually retire on SCHD? Here's a real example. A couple retired at the end of 2012 with $500,000 invested entirely in SCHD. No reinvestments, just living off the dividends. In 2013, They collected about $16,000 in dividend income. Fast forward to 2024, their annual dividend income had grown to over $53,000. That's more than triple, without buying a single new share, without lifting a finger. But that's not all. Their original $500,000 grew to around $1.45 million in portfolio value. So they didn't just protect their principal, they built serious wealth. And if they had reinvested those dividends instead of spending them, the portfolio would have grown to over $2.1 million. Now think about that for a second. While most retirees worry about inflation, this couple's income grew faster than inflation. Their lifestyle didn't shrink, it expanded. And get this, SCHD's worst year was down only around 5%, while the broader market sometimes dropped 20% or 30%. Sure, it's not the flashiest ETF, but when your bills are paid by dividends, flashy doesn't matter. Stability does. So, does this mean you should dump everything into SCHD tomorrow? Of course not. No single fund fits every person. But the numbers show it. For retirement cash flow, SCHD gets the job done. Next, let's meet a real investor who's actually living this strategy. Chapter 4. A real investor example. Craig Sutton's $200,000 SCHD portfolio. Let's take this from theory to a real person. Meet Craig Sutton. Online, he's known as SCHD Stan. Why? Because he's all in on SCHD. Literally. Craig started buying SCHD back in 2018. Fast forward to today, and he owns over 7,400 shares. That's about $200,000 invested in a single ETF. Now, what's his plan? Craig wants to grow his SCHD portfolio to $1 million by 2035. And here's the interesting part. He's not chasing meme stocks or hype trends. He's focused on steady, growing dividends. But let's be clear, he's not passive either. Craig doesn't auto-reinvest his dividends. Instead, he watches the price and buys more shares on red days. He likes buying the dip. That's how he builds conviction. And SCHD isn't his only investment. About 30% of his dividend portfolio is SCHD, and the rest includes the S&P 500 and some growth ETFs. So he balances cash flow and growth. The takeaway? You don't have to be a financial genius to build wealth. Craig worked in sales, saved consistently, and built his portfolio over time. It's a reminder, strategy beats luck. But what about times when SCHD struggles? Let's talk about that next. Chapter 5. Set it and forget it. Really, or should you just adjust over time? So, is SCHD really a set it and forget it ETF? Let's be honest, sometimes yes, other times not quite. The last couple of years have been tough. SCHD's stock price has been pretty flat, even negative at times. Meanwhile, tech stocks and growth ETFs have soared. Now, this happens for a reason. SCHD holds companies from sectors like financials, energy, and healthcare. When those sectors lag, the whole ETF slows down. But should that scare you? Not if you zoom out. If you look at the Dow Jones Dividend 100 Index, which SCHD tracks, you'll see it outperformed the S&P 500 and even the Nasdaq from the late 1990s to around 2014. So in certain decades, dividend stocks shine. That's the key point here. No ETF outperforms all the time. SCHD is built for stability, not for headline-grabbing returns. But here's what investors sometimes forget. Periods of underperformance usually leads to opportunity. When yields rise and prices fall, you're buying future dividend growth at a discount. So yes, you can mostly set it and forget it. But smart investors keep an eye on interest rates, sector cycles, and economic trends. Not to trade, just to understand. Let's clear up one more thing. Who is SCHD really for? Chapter 6. Common questions. Should young investors buy SCHD? What about retirement? Let's answer some common questions I hear about SCHD. Should young investors buy it Or is it only for retirees? Well, it depends on your goal. If you're young and chasing maximum growth, SEHD might seem slow. Growth ETFs like SEHG or the NASDAQ 100 could give bigger price returns. But here's the thing, dividend growth compounds too. If you start young, your dividend income could double every 6 to 7 years. That's a powerful snowball over 20 or 30 years. Craig Sutton started in his 40s, but imagine if he had started at 20. He'd likely already be living off dividends by now. For retirees, SEHD is simple. The dividends pay your bills. You don't have to sell shares in a bad market. That's the peace of mind SEHD was built for. Now, one tip. SEHD dividends are qualified, so they're tax-friendly in taxable accounts, meaning you can spend them anytime, not just in retirement. So whether you're young or retired, the point is this. Dividend growth rewards patience. The earlier you start, the bigger your future income. But SEHD isn't the only tool you'll need. Balance it with growth ETFs, cash, and maybe bonds. Chapter 7. SEHD versus the trendy Yield Max and Covered Call ETFs. Now let's talk about what everyone's asking. Why choose ETF when there are covered call ETFs paying 10%, 20%, sometimes even 50% yields? It's a fair question, but here's the reality. Covered call funds like YieldMax or JEPI generate income by selling options. That income is high, but the trade-off is lower growth. SEHD takes a different path. It pays you dividends from real company profits. It's not using complex trades to generate short-term income. And here's the kicker. Most covered call ETFs struggle to grow your income year after year. SEHD, it's been growing dividends by 11% annually. Now let's stir the pot a bit. Some call covered call ETFs fake income machines. Useful for a paycheck today, but maybe not for the next decade. In the long run, steady dividend growth usually wins, and that's where SEHD quietly shines. Chapter 8. Conclusion. So what's the verdict? Is SEHD truly a set-it-and-forget-it ETF? In many ways, yes. Its dividend growth has been steady. Its portfolio stays balanced and tax-efficient. And over time, the cash flow keeps rising, often faster than inflation. But let's be real. No investment should be fully forgotten. Even with SEHD, it pays to stay aware of changing market trends, interest rates, sector shifts, economic cycles. But that doesn't mean you trade it. It just means you stay informed. So yes, you could build your portfolio, sit back and let SEHD work for you. But if you want to win the long game, you'll check in now and then. Just like you check the oil in your car. The best part? The strategy stays simple. Buy quality companies, let dividends grow, and enjoy your life along the way. That's the SEHD way.